Hello and welcome to our discussion on a very important topic, college savings planning. Now you may be wondering, why is this so important? Well, the cost of education is steadily climbing each year, and without a proper savings plan in place, these expenses can become a significant financial burden. College savings planning isn't just about setting aside money for tuition. It's about ensuring your child has the financial support they need to pursue their dreams and ambitions without the shadow of overwhelming debt. It's about giving them the freedom to focus on their studies, rather than worrying about how they're going to afford their next semester. And it's about starting early, because the earlier you start, the more time your money has to grow. Planning for your child's college expenses is a crucial step in ensuring a bright future for them. So, let's dive in and learn more. Before we start diving into the specifics, it's important to understand the basics. At its core, a college savings plan is a long-term investment strategy designed with a key goal in mind: to help parents save for their child's future education. Think of it as a piggy bank, but instead of simply storing money, your savings are put to work, growing over time. This isn't just about stashing away pennies though, it's about proactive financial planning, and the earlier you start, the better. One of the appealing aspects of these plans is that they often come with tax benefits. Yes, you heard it right, your investment can grow tax-free, and withdrawals for qualified education expenses may also be tax-free. So in essence, a college savings plan is a double win. It allows you to save for education while reaping potential tax advantages. With a solid understanding of what a college savings plan is, we can now explore the different types available. There are several types of college savings plans available, each with its own set of benefits. Let's delve into two primary types of college savings plans: the 529 plans and the Coverdell Education Savings Accounts, or ESAs. Both these plans offer unique perks and come with their own set of rules. Starting with 529 plans, these are tax-advantaged savings plans, specifically designed to encourage saving for future education costs. They are named after Section 529 of the Internal Revenue Code and are sponsored by states, state agencies, or educational institutions. The beauty of 529 plans is that they offer high contribution limits and no income restrictions. Plus, the earnings in a 529 plan grow federal tax-free and are not taxed when the money is taken out to pay for college. On the flip side, 529 plans do have limitations. For example, they can only be used for qualified education expenses, and if the funds are used for other purposes, the earnings may be subject to a 10% penalty and income taxes. Now let's shift gears to Coverdell Education Savings Accounts, or ESAs. Unlike 529 plans, ESAs can be used for more than just college expenses. You can also use them for primary and secondary education costs. ESAs also offer tax-free earnings and distributions, which is certainly a plus. However, ESAs do come with some restrictions. The maximum contribution limit per year is $2,000, regardless of the number of accounts set up for the beneficiary. Also, there are income restrictions, meaning if you earn above a certain amount, your contribution limit may be reduced or even eliminated. Choosing the right plan depends on your individual needs and circumstances, but remember, the goal is to start saving early and consistently. It's never too early to start planning for your child's education. The best savings plan for you will depend on your financial situation, your savings goals, and your child's educational needs. So, take advantage of these savings plans and pave the way for a secure educational future for your child. Now that we've explored the various types of plans, let's discuss some strategies for effective college savings planning. One of the most important tips is to start as early as possible. The sooner you begin, the more time your money has to grow. Consistency is also key. Make saving a regular habit, whether monthly, quarterly, or annually. Inflation can eat away at your savings over time, so it's vital to consider its impact. Look for investments that can outpace inflation, which typically means taking on a bit more risk. Diversification is another crucial strategy. Spreading your investments across different types of assets can help reduce risk and enhance potential returns. Lastly, remember to review and adjust your plan as needed. Your financial situation, goals, and the economy will change over time, and your plan should adapt accordingly. Remember, every bit counts when it comes to saving for college. The earlier and more consistently you save, the better off you'll be. That wraps up our discussion on college savings planning. We've walked through the basics, explored different types of college savings plans, and shared some tips for effective planning. Remember, the key takeaway here is that planning for college savings is not a one-time event, but a long-term commitment. It's about starting early, being consistent in your savings, and adjusting your plan as your circumstances change and your child's education needs evolve. The power of compound interest means that even small, regular contributions can grow into a significant sum over time. So, whether you're a new parent just starting to think about your child's future, or a seasoned pro looking to fine-tune your approach, it's never too early or too late to start planning. So, what are your thoughts on college savings planning? Do you have a plan in place, or are you considering starting one? We'd love to hear your thoughts and experiences. Please share them in the comments below.